Thank you, everybody, for joining our Rocky Dollar presentation today. This is going to be a short presentation just about banking failures and investing. Today, we have Kirkland Capital Group, a very experienced team with Chris Carlsley and Brock Freeman. Going to let you guys take it away.
All right, thanks, Nick. We've had a lot of questions, probably more towards Chris, but around both the banking failures and how that's affecting debt in the real estate sector, particularly on commercial real estate. So because of that, we've put together some information, particularly because both of us have lived through a couple of different times where what we call left tail events like this. Chris in particular can talk about his time before. And we wanted to talk through what's happened and what you should be looking for if you're looking at private debt, which there's a lot of people turning to that right now because they want to see more steady returns, which is not a bad thing. I think that's a great thing. Of course, we're biased because that's what we do is private real estate debt. But I'm going to talk more in general about what you should be looking for in debt funds, not necessarily just ours.
Sure.
So,
you got
yeah, that's fine. No, you can. Just a quick introduction about Chris and I. Chris has got a long background in institutional fund management. That's gonna come out really quick here, as he's gonna kick off the next part and talk about bank failures. My background tends to be more on the real estate, technology, and real estate debt side, particularly. And so that's where I'm coming from, having been an underwriter, auditor, et cetera, for many years in that space. I'm not going to spend too much time here. All right, Chris, now, take it away now.
Yeah, we can pass up those two guys.
Yeah.
No, let's dive in. Let's talk a little bit of history here. This is a great little slide that I wish I could take credit that I found it. It was sent to me. It's a chart from the FDIC, and I'll kind of lead with I want to see what they put together in this chart and what this looks like a couple of years from now. So let's go back. We all know that 2008, 2009, 2010, what a horrific situation there. You can see in this chart, all of those bubbles are bank failures. And I actually found out by doing a lot of there's some offshore banks that, included in some of those bubbles were banks that were bought up because of weak balance sheets. So they technically didn't fail. They were absorbed into bigger institutions. But that's absolutely amazing. Definitely when I was living through it, I think I was in the forest, so I only saw the tree that I was about to run into, not everything else that was going on. The entire forest was on fire. But no, I was either fortunate or unfortunate to live through some of the major money center banks, especially Lehman, and then problems around lending where people were calling, billion-dollar credit lines for me. And they said, hey, we need the money in a few months, which, of course, we all know that didn't actually unfold that way. As much as they requested it, it didn't really happen. But luckily, there were still banks lending. Obviously, terms had changed, costs had gone up, but a lot of people were able to find, funds for their projects. Or in my case, I was working on a large fund-to-fund, and we definitely used leverage for that product. But you can see the big beast there was Washington Mutual Bank, which that's right down the road from Brock and I here in Seattle. What I want to also look forward is now let's go forward in time of what has actually just occurred. You're looking at Signature Bank and Silicon Valley Bank. Now, one of the things that when this chart came out, and Brock just brought it up there, was Credit Suisse hadn't actually announced yet, so we had to kind of manually enter it in there. I am sure it is a fairly large circle. Now we know that UBS came in and bought them up. We know that Citizens bought up Silicon Valley Bank. And so you're also looking at the problem going forward now. And what we saw in 2008 is what everyone is now learning is contagion. Now, for people who've been around for a while, we know exactly what that is. But for people who've been around for the last 10 to 12 years, you really haven't experienced that. You haven't really understood like how many people are in bed together, and when you push one person out, everyone else starts falling. So this contagion will carry through to other banks, and it's one of the things we're dealing with right now. And there's a great deal of uncertainty of, well, what will end up happening? What will happen to regulations? There's a lot of whispers on the wind that the way we're going to interact with banks, the way that banks are going to be able to offer liquidity to us might change. So it'll be interesting to see how they think they're going to fix some of the problems that occurred on the most recent run on the banks. Because, you know, we did have other banks like First Republic that, you know, yeah, they weren't doing everything that, you know, Silicon Valley Bank and everyone else was doing, but you had them being used as an ATM, which we saw a ton in 2009 and 10, perfectly good funds, perfectly good investment platforms, literally ground up because they could offer liquidity. They didn't do anything wrong. They had perfectly good numbers. And so I think you're going to continue to see some of that play out in this banking field. So, and how are we going to fix this? Is the government going to print money? I know that they came out with news and said, well, no, we're not going to put this on taxpayers. You know, we're going to have banks cover this. Well, how much can actually be covered? And don't fool yourself. If a bank is coming in to pick up one of these failed entities, they're going to be getting a deal. Otherwise, why would they be helping out? One of the things also, I know that we've had a reset in how people think about operations and operational risk because of this. The day before and the day of sort of the announcement, I had multiple phone calls from venture capital people that were like, hey, Chris, who do you know in banking, and get me a bank account super fast. And I kind of laughed. I was like, weren't you guys around in 08 and 09 when people realized you had to have multiple prime brokers? If you were a hedge fund, you had to have multiple counterparties as backstops and redundant systems. Well, obviously enough time had gone by that, you know, people had kind of forgotten that, or they weren't around when 08 happened. I mean, I talk about 08 happened last year, you know, like last year, but I realized it wasn't last year. It was a fair long time ago. But so those are the things that are sort of facing.
You saying something about our age, Chris?
Yeah, well, yeah, I give talks to students every once in a while, and it reminds me that I have nothing but gray hair left. So yeah, I mean, so now we're facing a lot of this uncertainty, and what do we normally see now? Well, banks are doing what banks do. They're going to huddle up. They're going to cut back on their lending. They're going to take less risk on their book, because the bank's job, at least most of these banks, is not to extend risk. They're there for an entirely different, you know, service. And so what we're already seeing is decrease in lending lines. You know, for Brock and I, and he'll talk a little bit about this, you know, we're seeing loans that we would have normally never seen from sources, from super regional banks that aren't covering, you know, small balance loans. They are changing their terms. I call it a rug pull. A lot of borrowers and people who own properties who are looking to purchase a property, they've always done business with one bank, and they don't bother to have multiple banks that they're talking to, and the rules change. Debt service coverage ratios change. They're tightening a number of different criterias, and all of a sudden, this deal that was good to go with a bank you've worked with for multiple years, probably multiple deals, all of a sudden can't do this deal. So we are in a very, very different dynamic period where, you know, people are just going to have to work a little bit harder, and they're going to have to find those new counterparties. It doesn't mean those counterparties won't come back. Everything cycles. You know, a major bank wanted $1 billion from me back in 08 and 09. I told them, I'll get it to you when I can. That obviously didn't fly very well. Some conversations got heated, but by 2010, we were friends again, and they wanted to lend to me. So, you know, don't panic. You will be, you know, back in favor with that bank that just did that little rug pull on you. But for this time period, you're going to have to, you know, be nimble and come up with something new. Obviously, what we're seeing, you know, on the back end of this, and also because of the Fed's move and their battle against inflation, is we've seen a massive increase in interest rates. Banks are going to increase fees if you do get a loan. The supply and demand imbalance, it already existed in private debt because of, you know, back in 2010, the Dodd-Frank rule. We are now getting a resurgent of that dislocation and the inefficiency in private debt. So you are now going to see wider spreads, but potentially wider fees as well. So multiple things going on, multiple things impacting broad lending. And then I'll let Brock talk a little bit about how it's impacting, the private debt standpoint.
Great. So in private debt, there's been a huge turn toward, it's become the popular thing. I mean, you see certain types of investments swing in and out of popularity. A year ago, a lot of people like debt. No, we want the equity. We want those high returns. We want to be in apartment complexes. I want to be on the equity side of things. Now it's all about, I want to be on the debt side. I want to be protected. I need downside protection. I want to be safe. And it's always good in your portfolio, and Chris can probably second this, that to have various investments at different risk levels in your portfolio, and not be completely what we call 100% risk on in the market. So it's always great to have debt. But now that there's this focus on debt, what should you be looking for as someone looking at a debt fund, looking to deploy some of your portfolio in a debt fund? And one of the things nice too is that Rocket Dollar is hosting us with this. Rocket Dollar, with their self-directed IRA, self-directed 401ks, what they have is really a great vehicle to invest in a debt fund, because debt funds generally are not tax advantaged. So this ends up being something where you're able to take advantage of the tax advantage part of your retirement funds and then invest in a debt fund. All right, so let me walk through a few things here around what you should be looking for when you look at a debt fund. And part of this is looking at both the manager of the debt fund, what they're doing in the debt fund, the types of real estate. Let me kick it off by talking about the property valuation process. This is super important. Out there, you're going to hear lots of things around, oh, we only make 50%, on the debt, 50% loan to value. Okay, but what's that value? It's important. It's going to make a huge difference between whether that's an as is current value. So what is the property valued right now as it sits versus what the value is in the future based on, let's say, things are going to get fixed up. So for example, one of the most famous types of loans out there are these fix and flip loans. So you go in, you buy a house and you buy it for 150,000 and you think, hey, it's going to be worth 250,000 by the time we get done. So I want a loan based on that 250,000. Well, that's a guess. That's an estimate. You may not get that in 6 months or 9 months when things are done. So you've got to look, if you want lower risk, look at using as is values. All right, next, what's your exposure to different asset classes? I don't think anybody pre-pandemic would have had an inkling that what used to be what most consider prime A1 type of debt going to office buildings in prime cities, gateway cities, was going to be risky at all. That was considered the most lowest risk, is to go buy some office building in a gateway city. All of a sudden now that's turned from what used to be a safe investment or considered a safe investment to something that's highly uncertain. And a lot of the news that you're seeing out there, almost I'd say the clickbait type of headlines, CRE crashing, CRE down, BlackRock, not paying their mortgages and they're going into foreclosure. But you start to read in those, and most of those are based on office buildings and office in prime markets, gateway cities, where they are down a tremendous amount, sometimes 30, 40, 50% on the dollar. It's highly uncertain. So when you look at a debt fund, you ask, what kind of asset classes are you in? Are you exposed? What is your exposure to office right now? Especially when that's such an uncertain thing now going forward with where things are at. Next, how often does that debt fund revisit underwriting requirements? Are they reactive or are they proactive? When do they revisit things? When do they adjust maximum LTVs? or even the pricing on things. And let me mention something else. This has came up in a conversation that Chris and I had recently with an investor who was talking about, oh, well, you know, do you just deliver a 12% return? And we said, no, we're not delivering any kind of constant here. There is out there. You want to make sure you read your PPMs and you look closely at what they're offering. Are they offering you a membership or a partnership within the ownership of the debt fund? So in other words, and then are you getting the risk reward passed through to you, or are you lending money to the lender, so to say, or to the fund, and they're just paying you a steady amount? So here's how that works. So number one, if a debt fund says, okay, we're just going to pay you 10% flat, okay? What's very likely happening out there, and again, you got to read your PPM, read the docs, is that they could go out and make a very risky loan at 18%. Now, the manager is capturing that extra risk reward of that 8% between the 10% they're paying you and the loan that they just made. You're not getting rewarded for that risk. So that's a good question to ask. Are you getting rewarded for the extra risk that's happening out there? Are you getting rewarded for the rates having gone up in the last 6 months to a year? And does that pass through to you as an investor? Another area to look at is whether the underlying properties are income generating now or could be very soon, or are you doing ground up construction or raw land, which has a lot more risk to it. Now, I am not saying that investing in vet funds that are doing raw land or doing construction is a bad thing. What you need to ask yourself, though, is if that debt is what you want as a risk. Are you wanting that risk, and are you being rewarded properly for that risk that you're taking on that type of ground up construction or raw land that's not able to produce the income? Are they doing senior debt positions? Are they first, or are they seconds? Are they doing gap financing? Again, it's all about risk. Are you looking for principal preservation? You probably want to be in first position. And on top of it, do you have full recourse? Are they doing personal guarantees with the borrower? So in other words, if there's a deficiency between what's owed on the property, if they have to go foreclose, can they go after the person, the guarantor, and go after their other assets to try and make up that deficiency where they weren't able to cover things? Again, it's all about principal preservation if you're looking for that. Lastly, there's been a lot of hard money out there over the years, which is asset-based, or they call it an asset loan, where the focus is on the asset and not the borrower themselves. So the issue here, though, is that it's going to be a higher risk. Maybe you get a higher interest rate, but the reality is you're going to be in a much better place if you're really looking at the background, or that lender is really looking at the background of that guarantor fully. We don't want any liar's loans. We heard about that in 08. That was one of the famous things about why the housing in those loans crashed in 08 was all the liar's loans. Oh yeah, I make, $200,000 a year and I can afford this $500,000 house. Turns out they weren't making anything and didn't even make their first payment and went into foreclosure. We don't want those kind of situations. You probably don't want those kind of situations. So, you want to look for the lenders. Are they doing full doc? Are they doing background checks, including criminal checks? Are they asking for full tax returns? Are they getting IRS tax transcripts to make sure that they actually filed them and they don't owe the IRS any money? Are they looking at bank statements to sort of legitimize and make sure that there's no fraud going on? So there's a lot of things there to make sure that you don't just have an asset, but you have a borrower, which is legitimate as well. So hopefully this will help you when you go look at a debt fund and you consider deploying money there. These are some of the things that you should look for when you're looking at that manager and looking at that debt fund.
One thing I might throw in there also, and it kind of links back to what we're kind of talking about, is the banks and the lending situation and rising interest rates putting pressure on equity. So you're looking at a lending fund, one other factor of potential risk mitigation. Now, I'm not saying anything negative about leverage, because I think leverage used intelligently can be a great tool. But in a market that we're facing now, if your fund, you're looking at any fund, let's just say, let's stick to what we're talking about. You're going to go look at a lending fund in real estate, and they use leverage. Understand, and you can request this information. You should understand who they're working with. Can you review the loan documents and understand the terms that that fund is under? Because you're going to be exposed to that risk as an LP in the fund. And they may not have a problem today, but given the uncertainty, what is that manager doing to ensure that they're not going to run into a problem? Are they shoring up some of that leverage? Or are they still, burning at full speed? And what would be the impact to you if there was a failure of that line where the bank wakes up, not today, but tomorrow, and cuts it? Because we're seeing a lot of that, where we're being told by brokers that, wow, I was working with this other lender, and all of a sudden now they don't have any money. And usually that is due to they were using some type of line of credit or some kind of facility to extend their business. Nothing wrong with that. But in this environment, you now have a probability and you are operationally exposed to the risk of a counterparty to the fund shuttering their business, and that has a direct impact to you. So that's another thing to consider.
Yeah, that's right. All right, to wrap it up, there's more information about us at our website, kirklandcapitalgroup.com. If you want to scan the QR code there, you can go grab a copy of this presentation today. Might help you walk through and really look more deeply when you do consider investing in a debt fund and what you should be looking for, as well as sign up for our passive investment newsletter, where we do cover a lot of educational items around investments in alternatives. Chris does a great job in publishing a ton of stuff out there. I publish a little bit more on the real estate side and the debt side, but if you want to know about alternative investments and educating yourself about those items, then the education that Chris puts out based on his vast experience is really a great thing if you're learning and trying to dig into that.
Yeah, we look forward to
Thanks,
it.
Nick.
Love to connect.
Thanks again, Chris and Brock. Really appreciate you spending time with us today. If you have any questions, feel free to visit their website, kirklandcapitalgroup.com. And we're definitely going to try to have you guys on a live webinar, hopefully.
Sure.
Take
Sounds
care.
great. All right, thanks.
Thanks.